Quantitative easing is a tool enacted by central banks to increase money supply and avoid deflationary pressures. Now, in the last decade, QE was among a host of instruments used by the Bank of England, the Bank of Japan, and the Federal Reserve to initiate expansive fiscal policies in the face of sluggish economies in each country. Now, when applying QE, central banks purchase bonds from financial institutions, either commercial banks or other businesses, such as insurance companies. Now, this increase in bank reserves is expected to encourage them to lend at lower rates to businesses. Second, having central banks buy bonds is expected to raise bond values, which will reduce long-term interest rates. In the past, cash would be printed by central banks when QE programs commence. Today, these banks create the money electronically, so no bills are physically turned over. Rather, the intangible reserves are transferred by the central bank to buy various securities. Japan was the first and most forceful among the three countries just mentioned to enact QE in 2001. Since 2012, the Bank of Japan has continued with its bold monetary easing programs, part of the widely known Abenomics Action Plan. In the U.S., the bursting of the real estate bubble set off intense monetary programs in 2008. Successive programs were to follow in 2010, 2011, and most recently in 2012. The UK government also reacted with a monetary stimulus program, which involved reducing the bank rate to 0.5% and the subsequent purchase of £200 billion of assets, mostly UK government debts or gilts. Two more phases of purchases would come in 2011 and 2012, bringing the total assets purchased to £375 billion. Evaluating the success of each country's policy reveals a bit of a mixed bag, especially with regard to the impact of QE on house prices, consumer confidence, as well as exchange rates. That being said, the general scholarly agreement that exists around the positive impact of QE policies surrounds the idea of the impact it's all had on industrial production in all of these countries in the last decade. Still, one can't assume the impact ends at the borders of Japan, the UK, and the US. The G4, the three aforementioned countries, plus the European Union, have been criticized by emerging countries such as China, India, Brazil, and Russia for the negative, destabilizing impact their QE programs have had on long-term yields, equity prices, and exchange rates in these countries. With the US, the UK, and Japan speaking publicly about an eventual withdrawal from the QE programs that they have going right now, this move could potentially trigger a shock to the developing world. Now, for more information on QE and other financial matters, visit the links below.